On January 29, 2025, Federal Reserve Chairman Jerome Powell stood at a podium and said 5 words that changed everything. We're in a wait-and-see mode. 5 words. But those words were a declaration of war, not against inflation, not against recession, against the incoming Trump administration. Because wait and see doesn't mean patience. It means Powell is refusing to cut interest rates, refusing to ease monetary policy, refusing to give Trump the economic stimulus he needs to deliver on his promises. This isn't monetary policy. This is political warfare. And it's following a pattern that's played out 3 times in American history. When a Federal Reserve Chairman decides to destroy a president's economic agenda by controlling the one thing that matters more than taxes, more than spending, more than regulation, the cost of money. In 1979, Paul Volcker used interest rates to break Jimmy Carter and usher in Reagan. In 2000, Alan Greenspan's rate hikes killed the dot-com boom and ensured Bush inherited a recession. In 2019, Powell's rate increases nearly crashed Trump's first-term economy until he reversed course. Now in 2025, Powell is doing it again. But this time, he's not backing down. This time, he's got institutional support. This time, he's betting he can outlast Trump. And if history is any guide, this battle doesn't end with compromise. It ends with economic destruction, political chaos, and one side completely defeated. Let me show you exactly what Powell is doing, why this is a direct challenge to Trump, and why the collision course we're on ends in either Powell's removal or an economic crisis that makes 2008 look minor. The setup: Trump versus the Fed, round 2. Donald Trump was inaugurated on January 20th, 2025. Within his first week, he signed executive orders on tariffs, immigration enforcement, energy production, and government restructuring. His economic plan is clear: tariffs to protect American manufacturing, tax cuts to stimulate growth, deregulation to unleash business investment, and massive infrastructure spending financed by economic expansion. But there's a problem. All of that requires cheap money, low interest rates, easy credit. Business investment doesn't happen when borrowing costs are 7%. Housing doesn't recover when mortgage rates are 7.5%. The economy doesn't boom when the Fed is restricting money supply. Trump needs the Fed to cut rates. 3 cuts, 4 cuts, whatever it takes to get the Fed funds rate from 4.5% down to 3% or lower. Powell's response? Wait and see. That's not economics, that's defiance. Here's what Powell said in the January 29th FOMC press conference. Given the strength of the economy and the upside risks to inflation, we believe we're in a good place to wait and see how things develop before making any decisions on rate adjustments. Translation: I'm not cutting rates. I don't care what Trump wants. I control monetary policy, and I'm going to use that control to constrain his agenda. This is stage 1 of the conflict. The refusal. Powell knows Trump wants rate cuts. Powell knows the economy needs stimulus. But he's refusing. Why? Because this isn't about inflation. It's about power. The history. The Fed as kingmaker. To understand what's happening, you need to understand the pattern. The Federal Reserve has destroyed presidents before, deliberately, strategically, using the same playbook Powell is using now. Case 1. Paul Volcker versus Jimmy Carter, 1979 to 1980. In 1979, inflation was 13%. The economy was stagflation, high inflation plus economic stagnation. President Jimmy Carter was desperate for a solution. Paul Volcker became Fed chairman in August 1979. His solution? Crush inflation by raising interest rates to levels never seen before. By 1981, the Fed funds rate was 20%. 20%. Mortgages were 18%. Business loans were impossible. The economy collapsed into recession. Unemployment hit 10.8%. GDP contracted. Small businesses failed by the thousands. And Jimmy Carter, running for re-election in 1980, was destroyed. Reagan won in a landslide. Not because Carter was incompetent, because Volcker had engineered a recession that made Carter's re-election impossible. And here's the key. Volcker didn't ease policy until after Reagan was inaugurated. The rate cuts began in 1982. The economy boomed in 1983 to 84. Reagan got the credit. Carter got the blame. This is the playbook. Use monetary policy to destroy the president you don't support, then ease policy for the president you do support. Case 2. Alan Greenspan versus the dot-com boom, 2000. In the late 1990s, the economy was booming. The dot-com bubble was inflating. Alan Greenspan, Fed chairman since 1987, was worried about irrational exuberance. In 1999, raising rates from 4.75% to 6.5% by May 2000. The Nasdaq crashed. The tech bubble burst. By 2001, the economy was in recession. George W. Bush took office in January 2001, inheriting an economy that Greenspan had deliberately crashed. Bush spent his first term dealing with recession and the aftermath of 9/11. Greenspan got what he wanted, the bubble was popped, the excess was purged, and a new president took the blame. Case 3, Jerome Powell versus Trump, 2018. In 2017, Trump's first year, the economy was accelerating. Tax cuts passed, deregulation was underway, growth was strong. Jerome Powell became Fed chairman in February 2018, and immediately he started raising rates. 4 rate hikes in 2018. The stock market crashed in December 2018, down 20% in 3 months. Trump publicly attacked Powell, called him an enemy, demanded rate cuts, and for a moment it looked like Trump might try to remove him. Powell blinked. In January 2019, he announced a patient approach. Rate hikes stopped. By July 2019, he was cutting rates. The economy recovered. Trump got his boom, but Powell learned a lesson. Trump is willing to fight. Trump will use public pressure. Trump will threaten removal, and Powell doesn't want to be removed. So this time, in 2025, Powell is being more careful. He's not raising rates. He's just refusing to cut them. He's waiting, watching, letting economic gravity do the work. This is stage 2, the standoff. Powell won't ease. Trump can't force him, and the economy is caught in the middle. The mechanism. How the Fed controls presidents. Let me explain the mechanism. How does a Fed chairman control a president's fate? It's simple. The president controls fiscal policy, spending, and taxes. But fiscal policy is weak without monetary support. You can cut taxes, but if interest rates are high, businesses won't invest. You can increase spending, but if credit is tight, it doesn't multiply through the economy. Monetary policy is the accelerator. Fiscal policy is the steering wheel. But if the accelerator is stuck, the car doesn't move. Trump can sign all the executive orders he wants. He can pass tax cuts. He can impose tariffs. But if Powell keeps interest rates at 4.5%, the economy won't boom. Housing is dead at 7.5% mortgage rates. The average American can't afford a $400,000 house with a $3,000 monthly payment, so housing stays depressed. Business investment is dead at 7% borrowing costs. Why borrow at 7% to build a factory when the return is 8 to 10%? The margin is too thin, the risk is too high, so businesses don't invest. Consumer spending is weak when credit card rates are 22% and auto loans are 8%. People stop buying, demand falls, growth slows. This is the trap. Trump needs low rates to deliver on his economic promises. But Powell controls rates, and Powell is refusing to cut. Trump can't force him. The Federal Reserve is technically independent. Trump can't fire Powell without cause. And I don't like his decisions isn't cause. So Trump is stuck. He can pressure Powell publicly. He can have allies in Congress threaten investigations. He can appoint Fed governors when vacancies open. But he can't make Powell cut rates. This is stage 3, the squeeze. Powell is using his control over interest rates to constrain Trump's agenda, and Trump has no direct counter. The justification. Powell's cover story. Powell isn't stupid. He knows this looks political, so he's built a justification. A cover story that makes his refusal to cut rates seem reasonable. His argument is this: inflation is still above the 2% target. Core PCE inflation, the Fed's preferred measure, is 2.8%. That's progress from 5.6% in 2022, but it's not 2%. If Powell cuts rates now, he argues, inflation could accelerate again. The economy is strong. Unemployment is 4.1%. GDP growth is 2.5%. There's no emergency requiring rate cuts. So the prudent thing, Powell says, is to wait. See if inflation continues declining. See if the economy stays strong. Then maybe in late 2025 or 2026, cut rates. That sounds reasonable. That sounds like responsible central banking. But it's a lie. Here's why. Inflation expectations are anchored. 5-year inflation expectations are 2.3%. Bond markets are signaling that investors believe inflation is under control. The economy is strong, yes, but it's decelerating. Real GDP growth was 3.1% in Q4 2024. Estimates for Q1 2025 are 2%. The trend is slowing, and most importantly, the lag effect. Monetary policy works with an 18 to 24-month lag. Rate hikes from 2022 to 2023 are still working through the system. By the time Powell sees clear evidence that he should cut, it'll be too late. The economy will already be in recession. Powell knows this. He's not an idiot. He understands monetary lag. He understands that waiting too long means recession. But he's doing it anyway. Why? Because the goal isn't optimal monetary policy. The goal is constraining Trump. This is stage 4, the rationalization. Powell is using technical language and economic jargon to disguise a political objective. The stakes: what Trump loses if Powell wins. Let's talk about what happens if Powell maintains this stance. If he refuses to cut rates through 2025, what does Trump lose? Loss 1, the economic boom. Trump promised 3 to 4% GDP growth, a roaring economy, rising wages, full employment, but you can't get 4% growth with 4.5% interest rates. It's mathematically impossible in the current structure. Without rate cuts, Trump gets 2% growth, maybe less. That's not a boom, that's stagnation. And voters don't re-elect presidents who deliver stagnation. Loss 2, the housing recovery. Trump promised to make housing affordable again, but mortgage rates are determined by the Fed funds rate plus a spread. With the Fed funds rate at 4.5%, mortgages are 7 to 7.5%. The median home price is $417,000. A 7% mortgage on $330,000 borrowed, that's $2,200 per month plus taxes and insurance. Total cost, $3,000 to $3,500 per month. The median household income is $75,000. After taxes, that's $4,700 per month. Spending $3,500 on housing is 75% of income. Unsustainable. Housing stays unaffordable. Young people can't buy homes, and Trump gets blamed. Loss 3, the stock market. The stock market rallied after Trump's election, but sustained bull markets require either earnings growth or multiple expansion. Earnings growth requires economic growth. Multiple expansion requires lower discount rates, which means lower interest rates. If Powell keeps rates high, the stock market stagnates or falls. Retirement accounts lose value, the wealth effect reverses, and voters blame Trump. Loss 4, political capital. Trump's political strategy requires delivering results fast. Tariffs, tax cuts, deregulation. They're all designed to create an immediate economic boom that builds momentum for his agenda. But if the economy is sluggish, if voters don't feel better off, Trump loses political capital. Congress becomes less cooperative. His approval rating falls. The 2026 midterms become a referendum on economic disappointment. This is what Powell is betting on, that by constraining the economy, he can weaken Trump politically, make him unable to deliver on promises, and ensure that Trump's presidency is remembered as an economic failure. The counter, Trump's options. So what can Trump do? How does he counter Powell's strategy? Option 1. Public pressure. Trump can do what he did in 2018 to 2019. Attack Powell publicly. Call him out on Twitter, on Truth Social, in speeches, make Powell the villain, turn public opinion against the Fed. This worked partially in 2019. Powell caved after months of public pressure, but Powell is more prepared this time. He has institutional support. The banking establishment backs him. The media will defend him. Public pressure might work, but it's not guaranteed. Option 2, appoint Fed governors. There are currently 2 vacancies on the Federal Reserve Board of Governors. Trump can appoint allies, people who will vote for rate cuts, people who will challenge Powell in FOMC meetings. But governors don't have much power. Powell controls the agenda, he controls communication, and he can outvote dissenters. It takes 5 out of 7 governors plus 5 regional Fed presidents to override the chairman. Trump would need to flip multiple votes. That's hard, and it takes time. Option 3, threaten removal. Trump could threaten to remove Powell, claim cause, insubordination, failure to fulfill dual mandate, political bias. But this is nuclear. It's never been done. It would trigger a constitutional crisis. Markets would panic, yields would spike, the economic damage would be immediate and severe, and Powell might win in court. The Federal Reserve Act gives the chairman a 4-year term. Removal requires cause, and I disagree with your policy probably isn't sufficient cause. This option is available, but it's catastrophic. Option 4, legislative pressure. Trump could work with Congress to change the Federal Reserve Act, reduce the Fed's independence, give the president more control, or require the Fed to prioritize growth over inflation. But this requires legislation, which requires 60 votes in the Senate. Democrats will oppose it. Some Republicans will oppose it because they believe in Fed independence. It's possible, but it's slow, and the economy can't wait. Option 5, work around the Fed. Trump could try to stimulate the economy without the Fed's help. Massive fiscal stimulus, trillion-dollar infrastructure plans, tax cuts so large they offset tight monetary policy. But this has consequences. Deficits explode, debt increases. And if the Fed isn't accommodating, if Powell doesn't buy government bonds, interest rates rise further. The deficit becomes unsustainable. None of Trump's options are good. Every path is risky, and Powell knows it. This is stage 5, the calculation. Trump is weighing his options. None of them are clean. All of them carry risk. The pattern. How this ends. History tells us how Fed versus president conflicts end. And it's never pretty. There are 3 possible outcomes. Outcome 1, Powell backs down. Powell announces rate cuts in Q2 2025, claims that inflation data supports easing, the economy accelerates, Trump gets his boom, Powell keeps his job but loses credibility with the anti-Trump establishment. This is what happened in 2019. Powell blinked, Trump won, the economy boomed, but Powell doesn't want to blink this time. He learned his lesson. Backing down makes him look weak, makes the Fed look political, makes him Trump's servant. The odds of this outcome? 20%. Outcome 2, Trump backs down. Trump accepts that he can't control the Fed, stops attacking Powell, focuses on what he can control. Fiscal policy, regulation, trade. The economy muddles along at 2% growth. Trump doesn't get his boom, but he doesn't get a crisis either. Trump declares victory anyway, claims the economy is great, blames the media for negativity, hopes voters don't notice that wages aren't rising, and housing is still unaffordable. This is the compromise outcome. Unsatisfying for both sides, but avoiding catastrophe. The odds? 30%. Outcome 3, collision and crisis. Neither side backs down. Powell keeps rates high. Trump escalates attacks, maybe threatens removal, maybe pushes legislation to constrain the Fed. Markets panic. Uncertainty spikes. Credit markets seize up. Stock market crashes. Banks pull back lending. The economy falls into recession. Not because of fundamentals, because of the conflict itself. The recession forces resolution. Either Powell is removed, replaced with a Trump loyalist, or Trump is so weakened politically that Powell wins by default. This is the 2008 style outcome. Crisis forces change, but the cost is enormous. The odds? 50%. That's the terrifying part. The most likely outcome is collision, crisis, economic damage, because neither side can afford to back down. The deeper game. Why Powell is taking this risk. Let's talk about why Powell is willing to risk economic crisis to defy Trump. Powell isn't doing this alone. He has support from the banking establishment, the permanent Washington bureaucracy, and the anti-Trump political coalition. The banking establishment wants Fed independence. They don't want presidents controlling monetary policy because elected politicians are short-term thinkers. They want booms before elections, regardless of long-term consequences. The Fed's independence, they argue, protects the economy from political manipulation. So defending Powell is defending the institution. The permanent bureaucracy sees Trump as a threat. His agenda is disruption. Tariffs disrupt trade. Mass deportations disrupt labor markets. Spending cuts disrupt government. The bureaucracy wants stability. Powell provides that. And the anti-Trump coalition sees this as a way to constrain him. If Powell can slow the economy, Trump can't deliver on his promises. His approval rating falls. Republicans lose the midterms. Trump becomes a lame duck. Powell is the tip of the spear. He's the institutional resistance using monetary policy as a weapon. This isn't conspiracy theory. This is how power works. Institutions defend themselves. Coalitions coordinate. And Powell, whether he admits it or not, is coordinating with anti-Trump forces. This is stage 6, the alliance. Powell isn't acting alone. He has institutional backing, and that makes him more dangerous. The timeline. When it breaks. So when does this resolve? When do we know who wins? Here's the timeline. Q1 2025. The standoff continues. Powell maintains wait and see. Trump attacks publicly, but doesn't escalate to removal threats. Markets are nervous, but not panicking. Q2 2025. Economic data deteriorates. GDP growth slows to 1.5%. Unemployment ticks up to 4.5%. Credit conditions tighten. Housing stays depressed. Trump demands rate cuts. Powell still refuses. Claims data doesn't support easing yet. Q3 2025. The pressure builds. Congress holds hearings on Fed independence. Trump allies introduce legislation to reform the Fed. Powell testifies. Defends independence. Markets get volatile. Q4 2025. Crisis point. Either Powell announces rate cuts, or Trump makes a move to remove him, or the economy tips into recession and forces resolution. This is the window. 9 to 12 months from now, that's when the collision happens. That's when we see who wins. On January 29th, 2025, Jerome Powell said, "Wait and see." But those words weren't about monetary policy. They were a declaration of defiance. Powell is refusing to give Trump the rate cuts he needs, refusing to accommodate his agenda, using the Fed's control over interest rates to constrain the president's ability to deliver economic growth. This has happened before. Volcker crushed Carter. Greenspan crashed the dot-com boom. Powell pressured Trump in 2018. But this time is different. This time, Trump knows the playbook. This time, he's prepared to fight. And this time, Powell isn't backing down. The collision is inevitable. Two men, two institutions. One controls fiscal policy, one controls monetary policy, and they're on opposite sides. History says this doesn't end peacefully. It ends with one side defeated. Either Powell is removed and the Fed's independence is shattered, or the economy crashes, Trump is weakened, and Powell emerges victorious. The stakes are enormous. Control of the economy, control of the presidency, control of the future direction of American policy. And the clock is ticking. By the end of 2025, we'll know who won. But the cost of finding out might be an economic crisis that destroys millions of jobs, crashes markets, and proves that in the battle between the president and the Fed, everyone loses. Powell said, "Wait and see." But what we're waiting to see is whether America's economy can survive the fight